buying into this thing, and we'll use the PowerPoint today because most of you have not read the chapter. Okay, so and then after you read the chapter, we'll talk about some of the tougher things in here. So we'll just kind of pound through it for now. What is going on? Okay. I say please work. Man, spell my name right. Okay. Oh, really?
Did you put a comment instead of a period for Bellman.edu?
Did I? Yes, you did. No. This class is just kind of work, isn't it? Have you noticed that? Every account class is just kind of work. Hard, it pays up. No, it pays off too, it's not well. Return, you get a return on what you did. Okay, come on. Come on. Everybody skip class today and they're all out of here. They tell me that it's over in Miles Hall, 3 o'clock on, you can't use anything. Computers just jam up totally. Everybody goes to their dorm rooms and plays video games, computer, do Facebook or something. We should have you guys in class 100% of your time. Solve that problem. Okay. So anyway, let's talk about the income statement a little bit. I hope a lot of this stuff is review from principles and kind of review from when we talked about chapter 1 and 2 and 3, right? And it's the same stuff over and over, but you really need to get this down, and it's review with additions, I guess is the way that I put it. So I need your test, and the quiz is up here. Anyway, so on the income statement, what do we use it for? Usefulness of the financial statements, right? Usefulness is the what? For chapter 2. Usefulness is what?
For basic criterion?
Yeah. Overall, overriding for basic criterion, right? Usefulness, you bet. Okay. So it's useful for evaluating past performance because we can predict what's going to happen with budgets, right? With forecasts, and then we can use it to evaluate past performance against that. What did we expect to have happen compared to what did? So you have an expectation. Okay. You compare yourself to other companies, sure. Okay, and then you can predict future performance. Actually, you can make decisions about what you should do next. Okay. All right. So it helps assess the risk or uncertainty of achieving future cash flows. What do you think you might use that for?
Whether to invest or not.
Whether to invest or not, sure. Okay, but that's also evaluating past performance and predicting future performance. What about risk and uncertainty? Do you guys know, are you guys aware of time value of money? Heard about that, right? Are you guys aware that we have, you know what, I think we should use that over there. Why not? It's sitting there, staring at us. I don't think everybody's going to finish the parking lot thing, right? And now watch, I'll use it, and then they'll come and say, wait a minute, throw it on parking. Okay, anyway, if you were to look at future cash flows and try to determine what they're worth, because that's what everything's worth. If you get run over by a truck going across that road, which would be really easy to do, I've come pretty close a few times to you guys, and it's really something. People turning to the right into our campus pay absolutely no attention to the crosswalk, to the light, to anything. Right? So I'm going to start carrying a spear to throw through their windshield. I mean, I've gone like this and have people look at, oh my God, I almost hit you. Yeah, no kidding, idiot. I'm about ready. I'm going to jump on the hood. And then I'm not going to be able to walk for the rest of the time. Which might be true, too. But hopefully it wouldn't be true, but I'm going to pretend I can't walk. You'll see me in a wheelchair, and I'm going to be a multi-millionaire. turn right there, stop. Yeah. So, they run the red lights too, though, so that's not going around that corner. Speeding on the red lights. Anyway, you get run over. What's your family consume like?
This kind of future cash.
Everything you got.
Yeah, the discounted present value of all the future cash flows you're ever going to earn, because you guys are sitting in this class that's just bumped up. A couple of million more than would have been otherwise. For this year, for the cap. Yeah, we're fine. Okay. Although the probability of that, in some of your cases, is kind of low, but yeah, we can put one like that. I mean, you can CBA. Anyway, based on performance so far. That's fine. Okay, anyway. So how do we determine how much is worth? Are they going to give them all the money you said we're going to make?
No.
No, it's not that much. How much would you have to invest now to have that much in the future, right? That annuity going into the future. So what are the three factors that you need to know to figure out how much he was worth when he got run over by a truck? Don't get run over, okay? It'd be terrible. Okay, I didn't say you were going to get it. What's the deal? What would it be? What would we have to ask?
How much you can make in a year?
How much? How much what? Cash flows. What else do you need to know?
How long?
Well, how much is how long? Okay. How many years? What's going to be each year? Right? For each one of them. But also, kind of related to how long is this what? What's he going to earn next year, the year after, the year after, the year after? It's when. When is going to get the cash flows? Okay? Also cash flows. How much cash flows? When are the cash flows happening? What else? What other features? To calculate the present value of anything, what do you need? You need to know how much the cash is going to change hands, when, and what else? The interest rate, the discount rate, which is what? Risk. So let's estimate that. It's the risk of the cash flows, but it's what? It's going to be 8%. What? This is the risk of never getting the cash flows. So how risky are they? That's why we give you guys a hard time. If you're doing absolutely horribly in here, your risk is extremely high. The estimated cash flows of somebody who becomes a CPA, we can predict those, right? We can predict when, based on how old you are, how many years you're going to work, all that sort of thing, right? The riskiness is related to, are they really going to happen? Okay, so what are we going to use? What are they talking about here? Risk or uncertainty of achieving cash flows? That's this. How uncertain are they? Right? If the company's cash flows are extremely risky, that means they are risky. The company's risky. They're worth less. What if their cash flows are really stable? You could predict them. You bet they're going to happen. What if you buy a treasury bill, U.S. government treasury bill? There's no risk. What kind of return do they have, however? Almost nothing. Why? There's no risk. When do you get a good return? When there's risk. Stock market over my lifetime has earned 12 to 13%. Wow. What do savings accounts earn? Right now, 0.5%, 0.25%. Right? What would you rather have, 12 or 13 or a quarter? Actually, right now the market's only earning about 8. That's because there's no inflation. Basically, no inflation. Although I don't know, we were talking about that. Is there really inflation or not? Yeah, so some things there are. Okay, always on some things. But there's deflation on gasoline, right? It all balances out. Not much inflation. So yeah, this is huge one. Huge one. We're also going to use the balance sheet to look at risk, right? Both statements are going to be good for really all of this stuff. Okay, fine. Limitations, we don't put everything in. Things we can't reliably measure, we usually leave out, okay? Income is affected by accounting methods used. If you're using straight line or accelerated depreciation to show that example, maybe LIFO or FIFO inventory, right? So the method you use, and then it involves judgment, okay? You might be overly optimistic, you might be too optimistic. And might people manipulate those statements on purpose? Yeah, or even just have a bias because they're not independent, right? They're not objective. Okay, so might they have a bias and yeah, my assets are going to last forever. My warranty expense isn't going to be very high. I don't have a big warranty liability because I believe everything's going to work out so well. Do human beings tend to be overly optimistic when they start a business? Yes. Okay, so you need to be careful with this. You're the accountant, either working for the company or outside as an independent CPA. You are not supposed to have a bias, right? The information is what? To be what? To faithfully represent, to be reliable. What do you have?
Free from error.
Free from error, complete, and neutral. Neutral is what? Unbiased. Okay, are people really unbiased? Not necessarily working within the company. Okay, you need to try, right? Try to be objective. Try not to be biased. Okay. All right. Anyway, quality of earnings. Okay, this is talking about the idea of managing earnings. There's two things that you might do. You might smooth your earnings. A proxy we are going to use. A proxy means like a proxy vote. You give somebody your vote, and they vote for you. You're a shareholder, right? And if you're voting, you could give them your shares to vote on your behalf because you trust them to vote a particular way, right? Okay, so a proxy vote. So a proxy is a substitute for it. Okay, a proxy for risk that we use all the time in economic models. A proxy for risk is the variability of the returns. What does that mean? The net income's going up and down, right? Year to year. One year to the next year to the next year. Okay? Or the dividends and the net income. The change in market price, you can measure a variety of ways, right? But there's fluctuation over time. If there's a lot of fluctuation, right, that's higher risk than if there's not very much fluctuation. Sound right? It is probably a pretty good proxy. If the earnings are real stable, they're gradually increasing, right? Or maybe it would be nice they're increasing rapidly, but it's stable, right? It doesn't go up one year and down the next, or quarter to quarter or month to month. That's the idea? That's a more stable company than one that's bouncing all over the place. They both might be earning a lot, but the one that's bouncing up and down we consider risky. It's a proxy for risk. Might people be tempted then to do something called smoothing earnings? And what smoothing earnings is well, take some from, if the earnings are a little too high this year, I'll take some out of this year and put them in next year. All I got to do is reduce revenues a little bit. Call some revenues that I have earned and unearned. Debit. Revenue, credit, liability. Net income goes down. Then next year, I debit the liability and credit revenue. Income goes up next year. Save it for next year. You can do the same thing with expenses, right? What do you do with expenses? Well, if you want more income, call it a prepaid instead of expense. Debit expense or prepaid instead of expense. If you have too much income, you can just debit expense, right? And credit maybe a payable, right? Record something that hasn't happened yet. If you need more income, you could debit accounts receivable, credit sales. You know, it really happened next year, but I'll record it this year. That's the idea. It's called smoothing, okay? You can do it through estimates, which is still unethical, right? To cheapen your estimates. Or you could directly, fraudulently record revenues you don't have, or, right? So you could go up and down. It could go both ways, but what happens then is you smooth it, right? Now, so companies have incentives to manage income or beat Wall Street expectations, because the market stock will increase if we meet their expectations, right? Stock options will increase in value if we meet the expectations. If we don't, we're going to get punished. It's going to go down. So is there temptation to cheat, particularly if you're close on the earnings? Yeah. Okay. So quality of earnings is reduced if earnings management results in information is less useful, of course, right? Can't tell what's going on. And they say predict future earnings and cash flows. I would add one piece. What's the big piece that they should have said here? Because you are going to smooth out their earnings. What are you doing? Perceived risk is less. So estimate the risk. Okay? That's what's really going on there. Okay? But it also affects your ability to predict future earnings and cash flows. Okay? By the way, which is a better predictor of the future, cash flow statement or income statement? By far the income statement, because you have to follow the accepted accounting principles. Cash flow statement, I can make my cash flow higher. Don't pay bills. It's not necessarily good for profitability not to pay your bills, but it gives you more cash flow. You won't replace equipment more now. You'll have more cash. You get the idea? Talk about a bunch of money, you'll have more cash. It's not necessarily good for the business, but you can manipulate how much cash you have really easily. It's tough to manipulate income if you follow the general accepted accounting principles. You pretty much have to tell people the truth if you really follow them. But remember, there's lots of estimates in here. Okay, there's another one called big back. Okay, smoothing is trying to even it all out year after year after year, so you don't have huge increases and decreases in earnings right over time. Okay, or dividends or however you want to measure or change in stock prices. So smooth it all out. Okay, that's smoothing. Big back is maybe it's already a disaster. The year's really bad, so I just throw everything in, including the kitchen sink. I expense everything. Because the market's already going to punish me, let's make it worse. They won't punish me a lot more. They can't punish me a lot more, right? Odds are they won't. So I debit expense and I credit payables. I debit the debit loss and credit my inventory. I debit bad debt expense and credit allowance for doubtful accounts for a huge number. I debit warranty expense and credit warranty payable for a huge number. Getting the idea? I mean, I just go crazy, reducing my income. When takeover artists take over companies, a lot of times they'll do this. They'll write off a whole bunch of stuff. Because then what happens in the future? You already wrote everything down. What if I wrote the inventory down? And now I sell it for normal price. What happens? My cost of goods sold is real low. My sales price is real high. I'm a winner. If I just took over the company, I'm a winner. If I just wrote everything down in this horrible year, the next year, boy, we sure turned things around, didn't we? Did you really turn things around, or did you cheat? Cheated. So the big bath is, of course, cheating too, right? But when one company takes over another one, you really have to watch for that. They'll do that. Okay. Big bath. The big bath hypothesis. And there's lots of support for it that it happens. Earnings are go crazy on the downside. When a new management takes over, the former management, they did a horrible job, right? Look at this. Look how much they lost. And then the next year, look what winners we are. We fixed it. Did you really? Maybe, maybe not. Maybe you did some good things. Right. Okay, why do they keep showing us all this stuff? Okay, anyway. You know about the elements, right? You already memorized these things? Revenues, inflows, or other enhancements of assets or settlement liabilities. What's the settlement liability? You're earning unearned revenue. That's it, yeah. They constitute the entity's ongoing major or central operations. That's a big thing, right? What's a gain? It'd be the peripheral stuff, right, guys? Okay. And also with the revenues, we have expenses associated with it. With the gains, we do not, right, guys? Okay. And a loss is similar to an expense, except the expenses are matched with revenues, and the losses are standalone. Okay, so sure. And they give you examples, big deal. Okay. You'll know what all these things are. You should be able to just look at them and know. All right, expenses, same thing. Outflows. Oops. Okay. The outflows are the using up of assets or occurrences of liabilities that constitute the entity's ongoing major essential operations. So no, that's that, of course. Gains, here they are. Peripheral or incidental, right? And there is no expense that goes with the gain, and there's no revenue that goes with the loss, okay? So examples, sure. Decrease in equity, net assets. By the way, you guys do realize that net assets is assets minus liabilities, right? Okay, net assets. Equity, no big deal. That's the types of things that we have there. Okay, multiple step statement, single step statement. Okay, here's the components. Let's see if we can find. There we go. Statement. All right. You should be able. I mean, you're going to be accountants, you guys. You're going to be finance people. You should be able to take a blank sheet of paper and create this. So I will expect that you will be able to do that. Okay. You should just be able to do this. It's just not a big deal. Okay. So what do we have here? Sales. Now, by the way, this statement has an awful lot of information on it. When you look at a publicly held company, their statement will never look like this. Private company might, because it's internal, so they'll put in all kinds of information for their own use, really, right, for a few shareholders. But if you're a publicly held company, you're probably only going to tell what you have to tell them. So on the face of the statement, a lot of times you'll have just sales. You'll have net sales, less cost of goods sold, gross profit, less operating expenses is income from operations. I'm not kidding. But then in either the notes to the financial statements, so ways you can disclose things, the income statement and the balance sheet. You can put information on the face of the statement. All this is on the face of the statement. You can put it in the notes to the statements. It's okay. So we can put that information, sales, revenue, less sales, discounts, sales returns, and allowances. You can put all that information in a note if you want. Typically, though, I won't use notes for numbers. I wouldn't put all of this stuff in a note. What I do instead is a supporting schedule. So you have a supporting schedule. It's still part of the financial statements, but it's just on a separate schedule. And it comes following the financial statements. Got the idea? So all of this detailed information could be there. Or really, in a publicly held company, they wouldn't even do that. They might just tell you what the total selling is and the total administrative to be done with it, just not give you the rest. But anyway, you could use those supporting schedules. And then another thing you could do is parenthetically. I don't see a parenthetically one here, but we could. Let's say sales revenue up there. We could show sales revenue and then put in parentheses net of sales discounts and sales returns and allowances and just show the net. Got the idea? So it'd be one line that would show the $2,972,000. You could do it that way, parenthetically. We do that with allowance for doubtful accounts, with depreciation, right? Accumulated depreciation on lot of the balance sheet. So those are the ways you could do it. Face of the statement, parenthetically on the face of the statement, in parentheses. Okay? In the notes or in the supporting schedule. Doesn't matter. As long as you disclose everything that's supposed to be disclosed. It's up to people to go find it. Okay? Anyway, so you guys do know that sales less cost of goods sold is gross profit. What kind of account is sales discounts and sales returns allowances? Yeah, they're contra sales. So this is a credit sales. These are both debits, right guys? This is a net credit. Cost of goods sold. By the way, they didn't show it. Go, what's cost of goods sold? How would you compute cost of goods sold? They should show it. It'd have to be in a note, I guess, right? The way they did it here. What would cost of goods sold be? Beginning inventory plus purchases plus freight in less purchase discounts less purchase returns and allowances will give me what? Available for sale less ending inventory is cost of goods sold. You guys all know this, of course, right? Be able to do it. Okay? It's automatic. So anyway, this gives an example. Notice these are the revenues, which are what? What we're in business to do. That's what we're selling, right? Normal course of business, right, guys? Central operations. These are all the expenses associated with that, and we get down to income from operations. Make sense? You take your sales less your cost of goods sold is gross profit. Sales less cost of goods sold is gross profit. You take away all your operating expenses, and what do you get? Income from operations. And this is unfortunate, the names that we use for these things. We have income from operations, and then we have income from continuing operations. And those are different things. Okay? So the terms are real similar, but they're different things. And notice what they've got here. These are what? Non-operating revenues and expenses, and gains and losses. Gains and losses that go in here. Other revenues and gains, other expenses and losses. Could use one category for it, but they're all the non-operating stuff. And then we get down to income before income tax. If you have discontinued operations or extraordinary items, that you read about, that you will read about in this chapter, you haven't read it or you did, you have read it, okay? Read this chapter and the next one carefully. There is a lot of new stuff, okay, mixed in with what you already knew. If we had discontinued operations and extraordinary items, this line would be called income from continuing operations before tax. And then we have the income tax. The income tax is on all the revenues and expenses from continuing operations, right, which include the main operations and non-operating, okay? Add the two together. So it's the peripheral stuff for the non-operating. Everybody got it? Peripheral or incidental, and it's from the major ongoing, what we're in business to do, for the revenues and expenses. But in any event, we'd come down here and we'd have income from continuing operations before tax. We'd have income tax on all of that earnings, right, or that loss. By the way, if you have a loss, you get an income tax benefit. If you paid taxes in prior years, you have a loss, you can file an amended tax return, right, or carry back, I'm sorry. You can carry back because you can get those tax dollars back. You might have a benefit, a gain from losing money effectively. Yes, sir?
What are some examples of peripherals?
Oh, dividend revenue, rent revenue. They've got some here. Gain on sale of a building. Gain or loss on refinancing debt. They've got interest on bonds and notes they decided to put down here. I usually prefer to put that up under administrative, but that's interest expense in this case. So a whole lot of anything that is peripheral to your operations, right? So if I'm Ford, when I sell an automobile, that's going to be sales and cost of goods sold, right? Okay. If I'm Ford and I sell an airplane, though, I'm not in business to do that. That's going to be a gain or loss. And Ford does own some airplanes. The execs fly around. Okay. UPS, right? It's freight, right? When they sell trucks, that's a gain or a loss. It's peripheral. They sell airplanes. It's a gain or a loss. It's peripheral, right? But when they deliver freight, that's revenues and expenses. Got it? So anything peripheral. Okay. Good. So that let us go down a little ways. Oh yeah, it does. I got it. Okay, so they show the tax netting for the year, and then earnings per share. Here's the deal: you must show earnings per share on everything from net income down. So if you have extraordinary items, discontinued operations, or extraordinary items, you show them in those two. Okay, so everything, we call this the line. Okay, the line is net income after tax. So, and well, look at that. They even called it operating and non-operating. Just like that. Everybody good? Easy. Make sure you get it down. Tax. Okay. Here's a condensed statement. So they just show less detail. Fine. Okay. So this is still a merchandising firm. By the way, merchandising firms sell merchandise. There are two types of merchandising firms. There's retail and wholesale. What's wholesale? You sell to another company. What's retail? You sell to the general public, right? Walmart's a retailer. Everybody good? General Motors is a wholesaler and a manufacturer. Also manufacturers, of course. Right? Okay. Manufacturers could sell to retail customers, but usually they don't. They usually sell wholesale. Everybody knows those terms, right? Just your general business classes. Okay. There they show the earnings per share again. And here, note D, they show the detail there. Okay, now this is a single step, so this is something different. On the single step, this is typically for service industry. Usually you wouldn't have cost of goods sold. You could do a single step for a manufacturer or a merchandising firm, retail or wholesale, but usually you wouldn't. Usually you'd want to show the gross profit. You show sales less cost of goods sold. You could do it this way if you want. But what if you're a service business? There's no such thing as cost of goods sold, right? They're selling services. So they would be far more apt to do this single step. They add up all their revenues, they add up all their expenses, the difference is net income. Got the idea? They even put income tax expense in here. You wouldn't have to, it's flexible. You could come down to income before taxes and then show tax expense and show net income. So you'll see a variety of things. The implication here is that any type of revenue or expense has none have a priority over another, none are more important. Versus in a merchandising firm, don't you think that cost of goods sold is probably the most expensive, or the most critical cost? So we show it separately. It's fine. Show gross profit. All right. Be sure and read. We won't talk about it most of the time. Be sure and read all these little. What page is this? Over on page 166. Be sure and read those to think about it. Right? They give some really good insights. These little yellow boxes, what do the numbers mean? These guys, it's interesting they use Chipotle because Chipotle was a high-flying stock. What recently happened to Chipotle?
What is it that they've had some?
Ebola.
It's not Ebola.
E. coli, not Ebola. That's what's real dangerous. Yeah, E. coli. Yeah, E. coli. They've had E. coli recently in several of their stores. Now they're big, and they're buying, and this is a bad thing that's happened to our food chain. There are really big companies that make a whole lot of stuff, which can work out really well for having costs reduced, right? Because they have efficiencies. What happens if they get contaminated? Everything's contaminated everywhere. So what probably was happening is they were buying produce, right? It's fresh produce, and it's hard to clean, and you don't cook it to kill stuff. So what happens? They serve fresh stuff. Any restaurant that serves fresh stuff. Or if you have fresh things at home that you eat, are really good for you, usually, unless they're poisonous, right? And so they had stuff in a whole bunch of different stores, and it hit, and the bottom's falling on their stock price as a result, because people aren't eating there like they used to, right? Now, is that going to last? No. And it was a really nice model. They were real popular. What was really sad for Chipotle, too, is they were catering to people who were well-educated and cared about nutrition. notice versus at McDonald's. And McDonald's would be quick when they have something go wrong. It's quick. Okay, so really important. But anyway, the idea here is what? Stock went crazy, probably went up way too much, so even though they're showing profits, what could happen to you? Not enough. You have to meet these expectations. Well, can you, after the fact, after you already sold everything you're going to sell and incurred all the expenses you're going to incur, can you suddenly manufacture new income the next year when you're doing the financial statements after the year's over? No, it's whatever it was. You just have to report what it was, and you can get punished. For good results, you get punished. Right now, Apple is having this happen. Apple made more money than pretty much any other company last year, and their stock value is going down. Why? It wasn't as much as people thought they were going to make. Nobody likes their ridiculous watches. Anybody have one of those watches that, you know, the phone, like Dick Tracy, you got one? Do you like it?
I do, yeah.
Pretty cool. What'd you pay for it? Did it get it?
Was a gift.
Yeah. But how much?
180.
180. That's not too bad. Of course, you can have a really nice phone for 182, can't you? Yeah. A real one instead of a watch phone. But you get to play Dick Tracy. You know who Dick Tracy is? The private eye that had, you know, back in the 1940s. They had a phone on its wrist. So everybody thought that's impossible. That'll never happen. Maybe someday we're going to all use those, right? But not this year.
You're close to it.
Yeah, but I don't.
Right.
This one I don't have to talk to anybody on because I'm antisocial. You know, it tells me when my phone's ringing and I can ignore it. It's great. Yeah, but it does. It's getting close, isn't it? Yeah. So, you know what I want it for? It says it's 12:35. So when I want to know what time it is, and you can't get regular watches anymore. But, although now regular watches cost as much as this thing does. Isn't that weird? And this is a little computer, which it has little green stuff flashing at the back. It's probably killing me. Don't you suppose? Radiation going into my wrist. It's a you call these fit. Yeah, fit. Yeah. What's that? Yeah, my heart rate. It's gonna probably that sound will go off if I die. You know, warn me that I'm dying. Okay, anyway. So, all right. I don't want to do these stupid questions. You can do it. Okay. Where did things go? Format of income statement. Yeah. Okay. You can look at just the main. When I say look at, if you take a look at page 165, and that's the one we just had up on the screen, if you knew everything from that page, and if I gave you a list of accounts in alphabetical order, you could get them in the right place, you have it made. Everything else that you're reading about is about that, okay, with where did things go and all of that. Another one that's a single step over on page 168, could you make the statement look like that? Would you notice if I said, do a multiple step statement or a single step? You guys would, right? Okay, developing the skill to pay attention to this.
I was just wondering, is there any way you want us to put the operating expenses? Like, if we put multiple there, if you want them in alphabetical order?
Oh, should they be in alphabetical order, or should they be from the largest to the smallest, or what? Whatever the company feels like doing.
Okay.
I kind of prefer alphabetical order myself so I can find things. Kind of find it annoying when they put the operating expenses from the biggest to the smallest. And what's funny about that is when you show comparative statements for 2 years, biggest to smallest doesn't work for both years a lot of times. They'll switch places, right? So I really prefer alphabetical. But obviously you keep your cost of goods sold up here, though. And then down in here when you do your selling and administrative expenses, you know, they could be from the largest to the smallest, or they could be in alphabetical order. Doesn't matter. Okay? So that's a good question, though. So it's personal preference. And I've had clients and bosses say, oh, I really like to have highest to lowest because the highest are most important to sales. So what am I supposed to do next year? Change the order? You want the order changing year to year? Or you can always make sure they stay in the same order. Oh, that's true. That's kind of, annoying. So I like alphabetical better. I can still tell which are bigger. You know, they're on a list. See bigger numbers. Yeah, okay. Pretty much. Enough of this stuff. All right. By the way, those are useful questions to do on Chrome. You can go through here and read them and look at them, but they're in the book too. Okay, some companies are required to report unusual and irregular items. For something to be an extraordinary item, it must be both what? Actually, 3 things. But it has to be what? To be extraordinary and disclose it, it would be what?
Material.
Both unusual and infrequent and material. Yeah, gotta be that. Although I don't know why we added material to that. Anything you can disclose separately should be material. Okay, but anyway, yeah. So what's this deal? They have 4 categories. Unusual gains and losses. What do you think, you guys? That's either unusual or infrequent, but not both, and that's a judgment call. If it's a loss, you know what people like to do? Say it's both unusual and infrequent, now I get to treat it as an extraordinary item, because extraordinary items you don't expect to continue year after year. If I think it's only unusual or infrequent, what do? I have to put it in with the non-operating items. That's those non-operating gains and losses, right? Okay. So would it be better for me if it's a loss, if it's extraordinary? Sure. What if it's a gain? Oh, well, now I'd rather it be unusual or infrequent, or even better. I'd like it up in operations, wouldn't you? I'd like all the gains in operations and the losses down in the extraordinary items, huh? No, you can't do that. You have to be objective. You have to actually think about what it is and apply your judgment, right? And by the way, when you get in fights with your boss over this, they're the president of the company and their background is marketing. They want to look as good as possible because that's their frame of reference, and it should be. Somebody's marketing my skill set to somebody else. I want him to tell how wonderful I am, not to tell the truth, right? And now, don't misrepresent my products, but, you know, the Big Mac looks pretty, right, in the ad. It doesn't look like it really looks. Wouldn't be very appetizing. If you show a picture, you know, you've opened up a Big Mac, right? Or you name it, right? Any fast food. You open up the package, it never looks like the pictures you saw on TV. And you're not particularly disappointed because you didn't think it would. Okay, but with the financial statements, it should be telling the truth, right? So this is a tough area. Okay, so we've got these things to worry about. Unusual gains and losses are going to go in the non-operating area. Discontinued operations is going to go separate. So is extraordinary items. And then the non-controlling interest we're going to work about too. We're going to separate. Okay, so this is a modified all-inclusive concept. All right. What are examples of unusual ones? Losses on write-downs or write-offs of assets. That's not an extraordinary item. Why not? It's not unusual. Companies have them all the time. Right? It's not unusual. Okay. Might it be infrequent for you? Oh, I hope so. I hope you don't have to write down your assets very often. Okay, but it's not both. Gains or losses from exchange or translation of foreign currencies. Do people do exchange and translation of foreign currencies into U.S. dollars or into some other currency, foreign currency? Now, sure, those gains and losses would go in there too. Okay, restructuring charges. Now, this one's tough. A lot of times what happens is people buy assets they really probably shouldn't have bought with hindsight. They incur costs they probably shouldn't have incurred with hindsight. And then what they like to do is they like to reorganize the business. They hire people they shouldn't have, now they're getting rid of them. If you show reorganization costs year after year after year after year, are they really reorganization costs, or are you just doing a crummy job running the company? And these are really just normal operating expenses for you. So if I see a company that has reorganization costs, I look at it really critically, because they'll put it down in non-operating. But you know, you're laying people off and you're paying them severance packages and stuff, and you're doing it every year, give me a break. Or you're closing stores, and you call it reorganization costs. Really? Close stores every single year? Right? I think that's operations. So when you're analyzing a company, when you're done with this, those of you who become finance types, accountants do it too, of course. When you're looking at it, if they have reorganization costs every year, just take it and put it up with your operations. It's part of their operations. Give me a break. What if they always have gains and losses on stock transactions? They put them down below. That's the same thing with interest expense down below. I think interest expense is a cost of operating. A lot of people put it down in non-operating. Fine, I just move it up when I analyze the company. So, because a lot of companies will put it in operations, right? A lot will put it down in non-operating. I make them all the same. You can do anything you want with financial statements when you're analyzing it. You need to be aware and be careful when you're reading, what's in the statements. Anyway, restructuring charges. It's legitimate. What if you only have one restructuring every 20 years or every 30 years? Okay, it's a restructuring now. I'll buy that. Right? It's fine. Except all these unusual charges. They're, right? Well, at least infrequent, right? Okay. So, all right. Other gains or losses in the sale or abandonment of property, plant, equipment, effects of a strike. You would think a strike would be an extraordinary item. No, it's not. You made it happen by not giving them what they want. By not having good employee relations, right? It's man-made, it's controlled. I like to think usually of extraordinary items as being things beyond your control, and usually they are, okay? So effects of a strike even. Adjustments to accruals or long-term contracts, well, so you're changing an estimate, right? So that's either unusual or infrequent, maybe. Okay, now this is really interesting. This is number of irregular items reported by 500 big companies in a recent year, whatever year it was. Anyway, 24 extraordinary items, 205 restructuring, good grief. Write-downs, gains, losses, sales, and assets, 301. I have no problem whatsoever with the write-downs. The extraordinary items are pretty infrequent in 500, and that's the way it's intended, okay? Very infrequent. To have them in a financial statement, infrequent, because they have to be both unusual and infrequent and material. So how many fit that? Not very many, right? 24 out of 500. Okay, restructuring, this is absurd. 205 out of 500 companies did restructuring, really? Think they're all restructuring? No, of course not. Okay? It's losses that they'd rather not have in their operations, so it makes their operating income look like. So be careful which line on the income statement you use is the point here. Okay? When you're looking at the companies. Discontinued operations, okay, now what's this? They eliminate the results of an operation as a component of the business. No significant involvement in that component after the disposal. This can be at a gain or at a loss. I might sell, this is a significant component of my business. I might sell it at a gain, might sell it at a loss. Remember the period of historical cost, right? So when you sell it, might that be a gain? Because the book values are real low? Yeah, okay. Could it be a loss too? Of course, okay? So we could have these both gains and losses. So you're eliminating a component. So Nordstrom's has men's and women's clothing. What if they decided to get rid of men's clothing? I don't know, I've been in their stores before. It's almost all women's stuff, but there's a lot of men's in there too. They started as a shoe store, Nordstrom's did. Still have good shoes if you want to spend a lot of money. Okay, but anyway, Nordstrom's, if they got rid of men's clothing, what do you think? I think that'd be a disposal to say. What if they decided they were no longer going to have gray men's handkerchiefs? Is there such a thing? There probably is. Nah, it's not a segment. How about if Lay's potato chips decided they weren't going to sell corn curls anymore? They're not going to have that. Probably not a segment. How about if they decided they weren't going to sell sour cream and onion? Probably not a segment. How about if they're not going to sell potato chips anymore? They sell a lot of other stuff besides potato chips, but that's a big chunk. What do you think? Probably a segment. How about if a company decides they are no longer going to sell, they sell stuff in all 50 states, and they decide they're no longer going to sell in California or anywhere, so they're going to shut it down? Probably a segment. Depends on what portion of their sales. How about if they decide they're going to get rid of Multnomah County? Now that's not a good county. Clackamas County. Multnomah is where most of it is. Clackamas County, which is adjoining Multnomah County. It's probably less than 1% of their sales. You get the idea? I think it's a little tiny market. Okay? Here, what would be a county here?
Spencer County.
Spencer. Yeah, Spencer's still pretty big nowadays. But yeah, if Spencer compared to Oldham or compared to Jefferson or something, yeah, got the idea? Hardin County, there you go, Hardin County. Wouldn't even notice, right? Got rid of that. So, is it really a discontinued operation? That's a judgment call. Okay, notice this. It's reported, it's not showing anything. Okay, it's reported net of tax, okay? Hang on, I did it. It's going to be reported net of tax. Anything that is below the line is going to be net of tax. What did I just tell you the line was?
The income.
Income after tax. Income after tax, we call the line, because taxes are out of it. So if you put anything below that, guess what? A gain or loss below that is going to have to be shown net of tax because you don't have the opportunity to take tax out again. Make sense? If it's a gain, we'll have a tax expense associated with it. If it's a loss, we'll have a tax benefit associated with it, okay? Right? Because if you have a loss, it'll offset your other income in your tax return. Does that make sense? Okay? So it's a benefit to you, okay? It reduces the loss, basically. All right, and here's an example. they show the income from continuing operations, and then in discontinued operations, here's a loss from operations, net of tax, and a loss on disposal net of tax. Now, this is the point here. We are going to show it separate from continuing operations. What would be above here? Revenues, all the expenses, right, from operations, operating income, then all the non-operating stuff, gains and losses, right, guys, and other revenues, other expenses. You'd come down to income from continuing operations before tax, take away the tax expense, right, and you would come down then to income from continuing operations. Instead of calling it net income, it's income from continuing operations. Got it? And before tax, instead of calling it income before tax, it's income from continuing operations before tax. It's logical. When you read this chapter, it makes sense, especially after we talk about it a little bit. Okay, anyway, all these are going to be shown net of tax. So what this was is a loss from operating. And then what this is a loss on disposal. Could this be a gain from operations and then a loss on disposal? Yes. Could it be a gain on both of them? Yes. Could it be the other way around? What would it be? A loss from operations and a gain on disposal. Quite common. Because remember, the assets are kept at book value, right? So you could have a gain, even though it's a loser. Okay? Now, the loss from operations, gain or loss from operations, is from the beginning of the year through the point when you made the decision to get rid of it. And here's the theory. That is accounted for separately from the disposal because it's usually bad news. I'm shutting it down, I'm laying people off, I'm giving them severance packages and so on. It's not really normal operations, but it's also not really the disposal, is it? You get the idea? Okay, so anything relating to operating it from the beginning of the year that you got rid of it through the date when you decided to get rid of it goes there. Now, we might keep operating after the point we decided to get rid of it, but we think that's part of the disposal, not part of the operation. So it's kind of, this is normal operations up to that point, and then this disposal is wrapping it up, shutting it down, and actually disposing it. What really makes this hairy is this could be in a different year. The actual disposal could be in a different year. And then we have to estimate what the loss is going to be. But if you think it's going to be a gain when you get rid of it, you won't record the gain. What you'll do is you'll report 0 for if it's going to be a gain on the ultimate disposal. You go ahead and report the loss on operations for the current year or the gain on operations for the current year. But if it's the actual consummation of the transaction, the end of this transaction is next year, we'd show a loss, an estimated loss on the disposal to be conservative, but a gain we wouldn't show. Why? Because we're conservative. Because you're just estimating. So that gets really hairy when you get into that sort of thing. Okay? And so what's the deal? If it's a loss, this is a net tax what? Benefit. So maybe I had a $500,000 loss on this, and I'm in a 40% tax bracket, so my tax savings is $200. Is that the idea? If it's a gain, it would be a tax expense. Okay? We'll look at some examples. Let's go along. It's brief. We didn't get anywhere, did we? Okay, and then the net incomes. By the way, what would you show earnings per share on? Everything from this 20 million down, every single line, okay? And I don't know why. I think it's kind of silly, but it's required, okay? So here's an example of where they put the discontinued operations. Oh, and this is the line, right? This line, income from continuing operations. They should have called this income from continuing operations before tax up here, okay? And you see how the discontinued, I like this one better. Income from operations of pizza division less applicable income tax. They got rid of their pizza division. Got the idea? So that's positive income less the tax expense. This is loss on disposal less applicable income tax, and they should say benefit on this one, right? So how much was your loss really on this one? 131, right? So 131 less 41 is 90. How much was your income from operating it? 78,800 it looks like. It'd be 78,800 less 24,800 of income tax is the 54. Got the idea? And again, earnings per share would be this line, this line, this line, this line, this line. Just do them all. It's the safest way. Okay? So, I guess we're leaving, are we? We're supposed to be. Maybe. Yeah. pick up there next time. Remember, I'm on page 28. Go pound through this. Read it carefully. Did you get the idea there's quite a bit in here? Did you get your head around? Quite a bit in the next one, too. What do I have? 2 days in each of the steps? All right. We do, don't we? I think so.
Is today one of those days?
Yeah. Yeah.
So it's a quiz on 4 and 5?
The quiz will be on 4 and 5 later. Yeah, I think so. So we have a while before the quiz, don't we?
12.
I just see there every week.
Yeah, we have some time. A little bit of time.
I just assume.
So did we actually record that? Wow, we did.
Uh,
Just in case.